$70 billion. That is the total transaction value of the buy now, pay later market in 2025. And you are not supposed to look past that number, but I did. 3 billion. That is the total outstanding debt. 70 billion in transactions, 3 billion in debt at any given time. The industry will tell you that means the system is working. Charge-off rates dropped from 2.63% in 2022 to 1.83% in 2023. Lower than credit cards, lower than personal loans. The Richmond Fed published an economic brief in February. Their conclusion is that the impact on financial stability appears limited at present. The story they are telling you is, this is safe, this is improving, this is fine. I want you to hold that story in your head for the next 10 minutes. Because I am going to show you what is happening on the other side of that story, the side where the rules of your credit file are being rewritten right now. While you are watching this, here is what happened. You opened your credit report. Maybe you were checking before a lease application. Maybe you were refinancing your car loan. Maybe you were just doing the responsible thing people keep telling you to do. And there it is, a line you do not recognize, a lender name you have never heard of. 7 outstanding loans. You did not sign 7 loan agreements. You bought a pair of headphones and split it into 4 payments. You bought a jacket, you bought a lamp. Each one of those is now a loan on your credit file. Not a purchase, not a transaction, a loan. They built the foundation of BNPL on one promise. This will not follow you. It will not show up on your credit report. It will not affect your score. That was the deal. That was the whole pitch. And now, someone is jackhammering the foundation while you are standing on it. The 1st of April, 2025. That is when Affirm started reporting every single pay over time loan. To Experian, every loan, May 1, they expanded to TransUnion, every loan, including pay in 4, the ones that last 6 weeks. The ones you took out to buy a $37 phone case because the checkout screen said pay in 4, no interest, and you thought sure why not. That $37 phone case is now a loan on your credit file. I am going to say that again because I need you to hear it. A phone case on your credit file as a loan. Affirm says, and I am going to quote this because the framing is remarkable. People deserve credit for managing their money responsibly. That is their stated reason. They are doing this for you. They want to help you build credit. Just like a casino says it offers free parking because it cares about your commute. Now, here is where it gets interesting. Klarna did not follow. Afterpay did not follow. According to the Wall Street Journal, they said traditional credit scoring models might misinterpret frequent, short-term BNPL usage or small missed payments as elevated credit risk. They are saying, the system is not built to understand this product. If you put this data in, it will hurt people. And you know what? They are probably right about the mechanics. But that is not why they are withholding data. They are withholding data because if your BNPL shows up on your credit report, you might think twice before clicking Pay in 4 on a $60 purchase. And if you think twice, they make less money. Both sides of this are protecting their revenue and calling it consumer advocacy. So right now you have Affirm reporting everything, Klarna reporting nothing, Afterpay reporting nothing, and your credit score sitting in the middle of a civil war it did not sign up for. This is all public data and public math, not personal advice for your specific credit situation, but look at what these numbers actually say. Let me show you what this looks like for a real person. 27 years old, marketing coordinator in Charlotte, pulls $58,000 before taxes, credit score 712. They have used Klarna maybe 15 times in the past 2 years. Afterpay a handful of times. Affirm twice, a desk lamp and a pair of running shoes. They never missed a payment on any of them, not once. They are what the industry would call a responsible user. Here is what their credit file looks like today. 2 Affirm loans reported closed. Paid in full 0, Klarna activity visible 0 Afterpay. Even though they use those services far more often, the credit file shows someone who took out 2 short-term loans and paid them back. It does not show someone who has split 30+ purchases across 3 providers. Over 24 months, those other transactions are invisible, ghost transactions. The regulators have a name for this. They call it phantom debt. And for now, this is the part that matters. Those 2 Affirm loans are not being factored into their score. Affirm said publicly that until the rest of the industry reports, the data stays in a holding pattern, visible to you on your personal file. Not visible to lenders, not touching your number. But FICO has already built the model. They published it on their blog the 12th of March of this year. It is called FICO Score 10 BNPL. They ran a 12-month study. On 500,000 consumers using Affirm data, 85% of people would see a score change of 10 points or less. 97% of heavy users, 5 or more accounts, would see less than 20 points of movement. That sounds fine. 10 points. Who cares about 10 points? Until you remember something, that study was done on Affirm users only. People who already went through Affirm's individual transaction underwriting. People who were already screened for risk before they got approved. The responsible ones, the clean data. What happens when Klarna caves, when Afterpay caves? When all those unscreened, unreported transactions from every provider hit the system at once? Nobody has run that study, because that data does not exist in a credit bureau yet. And the model that is waiting, the model that is built and ready to deploy, has never been tested on dirty data at scale. Now I need you to go back to that first number I gave you. Industry charge, off rate, 1.83%, improving, getting better, safe. Here is the number on the other side, 47%. That is the percentage of BNPL users who said they made at least one late payment. In the past year, LendingTree surveyed over 2,000 people in March 2026, 47%. Up from 41% in 2025, up from 34% in 2024. 13 percentage points in 2 years going the wrong direction. The industry data says things are getting better. The consumer data says things are getting worse. Both numbers are real. They are not contradicting each other. They are measuring different things. The charge-off rate went down because, and the Richmond Fed says this directly, citing the CFPB's analysis, the industry shifted toward deepening usage among existing customers rather than expanding to new borrowers. They stopped giving loans to people who would default. The people they kept are paying late more often. But because they cut the riskiest borrowers from the pool, the overall rate looks better. That is not an improvement. That is a card trick. You reshuffled the deck and told me the average card is higher. It is. Because you pulled the 2s and 3s out before you started counting. And now, right now, the credit scoring system is deciding how to treat your BNPL behavior. The CFPB found that 63% of BNPL borrowers had multiple loans outstanding simultaneously. 1/3 borrowed from more than one provider. These overlapping obligations have been invisible to lenders, invisible to scoring models, invisible to the system that decides whether you get approved for an apartment lease or a car loan or a mortgage. The Richmond Fed calculated that $3 billion in outstanding BNPL debt at any point in time. That is 400 times smaller than credit card debt outstanding. Sounds negligible until you realize that $3 billion is spread across tens of millions of individual credit files. It is not concentrated, it is scattered. A $40 loan here, a $90 loan there. Each one individually meaningless, collectively. A new data layer that scoring models have never had to process before. And here is what that layer looks like from the consumer side. 54% of BNPL users say they cannot make ends meet without these loans. 29% are using them for groceries, double from 2 years ago. These are not people financing luxury purchases. These are people splitting a Kroger run into 4 payments because the alternative is overdrafting their checking account on a Tuesday. And somebody just decided those Kroger payments are loans. And those loans are about to enter a scoring model that was designed for 30-year mortgages and 5-year auto notes and revolving credit lines. A model that interprets a new account as a new risk. A model that penalizes you for having too many recent inquiries. A model where the average age of your accounts matters. And you just added 17 6-week accounts in 12 months. How many of you have checked your credit report in the last 90 days and actually looked at what is on it, line by line? Because if you used Affirm since April 2025, there is something on there right now that was not there before, and most people do not know. The foundation is not being repaired. It is being jackhammered and rebuilt to someone else's blueprint. While you are still standing on it, you did not move, the ground moved. That person in Charlotte, 712, credit score, responsible. Never missed a payment. If, when all their BNPL data hits their credit file at once, from all 3 providers, here is what the model sees. 30+ short-term loans opened and closed in rapid succession. Multiple accounts with multiple lenders, high account velocity. In the language of traditional credit scoring, that pattern looks like financial distress, even though it is actually someone buying headphones and a jacket, and a lamp and a phone case over 2 years. 85% of people in the FICO study saw 10 points or less. But that study used clean Affirm data from screen borrowers, making on-time payments. The real-world scenario, all providers reporting simultaneously. 47% of users with at least one late payment. 63% carrying multiple loans has not been modeled. Nobody can tell you what that does to your 712. Not yet. But the system is being built. And it is being built on incomplete data with untested assumptions. Here is where you go from here. Your credit file is yours, and you have the right to see exactly what is in it. Annual Credit Report.com. That is the federally mandated site. Not any of the paid services gives you free weekly access. To all 3 bureau reports, pull yours, look for accounts you do not recognize. Affirm might appear as Affirm Inc. or Affirm Loans. On Experian and TransUnion, if it is there, you now know why. The CFPB maintains a complaint portal at consumerfinance.gov, specifically for credit reporting disputes. If you see a BNPL loan on your report that is inaccurate, wrong amount, wrong payment status, an account you genuinely do not recognize, you can dispute it under the Fair Credit Reporting Act. The Bureau has 30 days to investigate. And if you want to understand the mechanics of how the scoring model is about to change, what FICO Score 10 BNPL actually does differently, how it aggregates multiple concurrent short-term loans to prevent them from looking riskier than they are. They published the methodology overview on their blog the 12th of March of this year. It is public, read it. Whether that aggregation logic actually holds when it encounters messy, incomplete, multi-provider data at scale is a different question entirely. One that nobody, not FICO, not the bureaus, not the CFPB, can answer yet. Because the data has not arrived. I do not usually say this, but if you know someone in their 20s who uses BNPL and thinks it does not touch their credit, send them this. Because the rules changed, and nobody sent them a notification. The rules changed, not because you did anything wrong, not because your behavior changed. The rules changed because one company decided to report, and 2 decided not to, and a scoring model was built on data from only the responsible slice of one provider. And now the system is building itself around incomplete information and calling it progress. $3 billion scattered across tens of millions of credit files. And the model that is about to score it has never seen the full picture.